Nvidia, how you toy with us. The biggest company in the world by share in the S&P 500 reports results. Those results underwhelm. The markets don't like it, but they certainly don't take the sentiment hit. Now what? This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we're going to explore what happened here and look ahead to the next inflection point in this story that is going to come at us to close out this week. And that, of course, is going to be the Fed's favorite inflation gauge, the PCE index. And of course, a very relevant part of the story here, because as ever, we are looking at a market that came into this week focused on the Fed and now looks as though we are going to be finishing the week in the same fashion. The story, of course, was relatively positive with that lead, but it didn't quite materialize that way this week, perhaps until now. Let's unpick what happened here first and foremost with this Nvidia report and why it did or did not give us a sentiment a lead, and go from there to see what could be approximating next steps here. So let's first take a look at these results. And we can see here, this concludes the so-called Magnificent Seven reporting period. We get slightly better than expected outcomes. We get a slight beat on EPS, we get a slight beat on revenue, but ultimately nothing controversial and nothing out of sorts. In fact, if we consider here what these results actually amount to being, they're not exactly the most shipper of even Nvidia's own results. So this was a beat of 4.12% on the EPS side. That's the smallest beat since the third quarter of 2022, when earnings disappointed to the tune of almost 18 and a half percent, a little bit more, 1.51. That was the smallest beat since the fourth quarter of 2022, when we only beat by 0.6%. So these are nominal beats, but they're not anything like some of the larger outperformance readings we've seen from Nvidia before. And as we discussed leading into this report, the other 6 of the Magnificent Seven here likewise beat on their results, some explosively. And of course, Meta is standing out here crystal clear with a 7.14 EPS against an estimate of 5.85. Clearly a massive gap there. In fact, the only one that didn't beat is Tesla, which narrowly met its EPS forecast. So we went into this having seen those beats already, and then having looked at how the markets responded, and concluded that the bar seemed to be relatively high for Nvidia to deliver results. We can see here the Roundhill Magnificent 7 ETF. There go the Google and Tesla results. We can see the grouping as a whole is basically listless. Then we get the results from Meta and Microsoft, and of course we just saw those Meta results in particular were absolutely off the charts, and so they get reported after the close. We get a gap, but then the markets faded, and faded some more when we get was the bar for these AI linked and tech stalwart names is high. In fact, we're looking at this subsequent rally in the market as a whole. There's that Mag 7 ETF. There's the S&P and the Nasdaq, and we've used the ETFs here, SPY and the Qs, just to make sure that we're lining up our data as cleanly and as analogously as possible. And so we have the reporting period right here. So you can see that this was from the 23rd through the 31st. There is that period right here from the 23rd to the 31st. And we can see that, indeed, we are listless. We fade Meta, Microsoft, and the last part of this reporting period. We then have this, and we can see likewise that it is more so a change in Fed policy expectations that gives the markets a broader fillip than it does any of these earnings reports beating expectations. There's a clear downshift here in the Fed funds expectation that's priced into December's Fed funds futures, which is what this is. This is the implied rate. We can see we take a step lower here from north of 4% down to 3.85. So this downshift here seems to be the catalyst until we get into the US CPI report on something of a wall. Of course, that wall, depending on where you look, has started to get breached on the upside. More on that in just a second. But we came into this Nvidia report with having the preceding Mag 7 names, having delivered and over-delivered, in some cases, obviously Meta most obviously, and the markets having yawned at it and said, you know what, this is just not impressive enough. And as we can clearly see from Nvidia's results here, the narrow beats, the sort of inline-ish outcomes. Clearing the high bar is not exactly what this looks like. Now, because the bar was set high and because these names are such huge parts of the weight in the S&P 500 index, which is sort of the benchmark for risk appetite market wide, and indeed Nvidia is the biggest, we reckon that we might have a situation here where this isn't just about one company or a set of companies. This is about sentiment. This is about the overall market mood. And if the bar is high and the market mood is at stake, then a disappointment doesn't just hurt Nvidia, it probably hurts the broader market. Moreover, we came into this with a bit of idiosyncratic risk. We can see that the expected gap on Nvidia's estimate for fiscal third quarter revenue is yawning. It's much, much bigger than anything we see over the preceding several quarters. And that's because we don't have clarity on what's going to happen with shipments to China. First, we get a ban on chip shipments to China. Then the Trump administration has a U-turn and says, well, actually, it's fine, go ahead, but you're going to have to give us a 15% cut of everything that you sell. And so it's unclear then whether the forecasts for revenues will include China sales, not include China sales. And so there's this big disparity here that the markets are reckoning with. So what happens? Well, as we just said, the results were not especially impressive relative to expectations. They beat by very narrow margins, and in fact, the smallest margins in quite a long time. Nvidia approved a $60 billion share buyback. They said there were no sales of the H2O chips to China in the second quarter. And on that key revenue point, They only projected 54 billion plus or minus 2% for the third quarter, which was against an estimate of 53.5 median. But so we can see the disparity here is huge. It runs from under 50 billion to well over 60. And at 54, we're sort of obviously erring on the low end. So the markets did not like it. They sold off as one might expect. So did this sink sentiment? Well, the clear answer is it did not. Moreover, Nvidia actually ends up finishing the day modestly lower. We can see that most of the drop is erased. These are 4-hour bars, by the way. Most of the drop is erased, but we still end up net lower relative to where we started this story before the earnings report came out. But this clearly does not extend into a broader risk-off mood as we get into today's market action. So we can see here, this was the week up to the close before the Nvidia report. We can see stocks are listless. There's a little bit more follow through on the bond side, especially at the short end. Yields a little bit cooler. Gold's a little bit higher, perhaps thanks to what's going on here. Gold is sort of a preternaturally anti-yield kind of creature because it doesn't actually yield anything. The dollar is nevertheless stronger, and Bitcoin, the risk appetite on steroids asset of the bunch, it's still down significantly on the week. So we come into the markets kind of idling. And this is what happens with week to day performance the day after. So clearly, in the wake of Nvidia and in the wake of this disappointment, which the markets clearly present as disappointment. So there's no question here that the market saw this and said, this is not good news. Nevertheless, the market says, yeah, but it isn't damaging for sentiment, and in fact, it is going to be good enough. So we end up with now much more convincing gains for the S&P and the NASDAQ for the week. I mean, compare this with where we were for the week yesterday, and that's clearly on display. We get a little bit of a reshuffling on the bond side where we even out a little bit. So the decline in front end rates moderates a little bit. The back end extends out a little bit. Gold continues to build, and the US dollar gets closer to even. So it's still a little bit higher on the week, especially against the euro, but against the more yield sensitive and the most kind of directly yield sensitive yen, we're back to neutral, having been much stronger earlier in the week. And Bitcoin is still Bitcoin with basically the same move. Now, this starts to look a little bit more like where we ended last week in the wake of a speech from Fed Chair Powell that the markets judged as setting the stage for rate cuts in September, which was an idea that they roundly cheered. We can see stocks had a nice day higher, yields fell, gold was up, the dollar was down, Bitcoin was sailing. So we had a very clear-cut response, but the markets did not find follow-through in that response this week. Again, as we can clearly see here, if this was the lead-in, then we did not pick up that baton on Monday. This was the week, Monday through Wednesday. No follow-through in stocks. Dollar goes the other way. Bitcoin goes the other way, and we get some modest follow-through, maybe on front-end yields, maybe on gold, but ultimately nothing deviates from long-standing ranges. So it's very interesting that what we have is then an Nvidia report that disappoints and sentiment recovers. It is as though the markets reset after this report to say, all right, well, the big event risk between Powell's speech on Friday and the next bit of Fed news is going to be this Nvidia report. We're not going to make a bet until that report comes out. Once it comes out, as long as it isn't catastrophic, I don't think is what this was, though clearly a letdown, as the price action itself attests, we end up with essentially getting back to saying, okay, well, that was fine, and we can get back to talking about the Fed. That, of course, brings us to the next inflection point. The PCE index, the personal consumption expense, mostly anchoring policy around. And the expectation here is that we're going to get an uptick. This would match which way CPI went earlier in the month. But of course, that CPI report ultimately ended up giving the markets a lot of clearance in their thinking about a Fed rate cut in September, because while inflation went up, it did not go up in a way that ruffled any feathers. The expectation here that we're going to go up to 2.8 on the core. That would be the highest since February, and 2.6 on the headline. That also the highest since February. So we're looking at essentially 5-month highs. And when we look at the CPI number, we have something similar. CPI came out at 2.7% headline. That was a 5-month high, although the expectation was it would be a little bit higher, that it would be 2.8, and that's ultimately why the markets seem to be relatively enthused about those results. The core number, though, 3.1%, again, 5-month high, and higher than expected at 3. So we're looking for PCE to broadly match what CPI gave us. And of course, let's keep in mind CPI is already, of course, priced in. So where are we on Fed policy expectations going into this thing? Well, we're still hovering comfortably at about 85% chance that September will give us a rate cut. We can see that that's held relatively steady versus the pre-Nvidia world of yesterday. We can see it is much more conviction than where we were just ahead of Powell. That was sub 80%, and certainly much more convincing than the wider spread a month ago in late July, where the markets thought, okay, there's about a 35% chance that rates stay unchanged. There's just over a 60% chance that we get the one cut, and then there's even a possibility that maybe we get a 50 basis point reduction. But of course, the markets disabuse themselves of those extremes in short order. And so things over here look pretty stable, and the level of conviction looks pretty solid. Perhaps the larger issue is that there continues to be a dramatic disparity between what the markets and the Fed expect for next year. Now, since basically the middle of May, the markets have been comfortably anchored around the Fed's forecast for 50 basis points in rate cuts this year, give or take here and there. And of course, the markets don't move in straight lines. You're bound to get some wiggling around these levels, but we can see that there's a clear sort of range that is established right here. And of course, the Fed has been saying that they're aiming to cut rates by 50 basis points this year, going all the way back to December of 2024. That forecast has not changed. So the markets are with Powell's speech on Friday last week that indeed we're going for this one cut in September. That leaves October and December for policy changes, and the markets seem to think, well, they've gotten themselves this far. This is about where we're going to land. The disparity is about next year. In its latest update of the forecasts here, the Fed said we're only going to do one 25 basis point cut next year, whereas the markets have only moved in a more dovish direction recently and are now at 81 basis points for next year. So that means 3 cuts are all the way baked in at this point. So that's already 2 more than the Fed has owned up to. And then when we get to benchmarking what happens with a 4th move, because indeed we are here in excess of 75 basis points, which would be 8% chance that there is a 4th cut on the menu here next year. So the disparity between the markets and the Fed clearly continues to be yawning. And the markets are, of course, much more dovish than the Fed has owned up to, at least at this point. Of course, in September, the next policy meeting, we are going to have a revision of these summary of economic projections, readings from the Fed. So we'll see if they've moved any closer to where the markets are, let's say from 1 cut to 2, at least to show some direction, some movement in the same sort of trajectory where the market seemed to be pulling policymakers. So the bar, again, from a sentiment perspective and from a surprise perspective, seems relatively high. These PCE numbers would have to go a long way to telling markets that the Fed is prepared to make a shift in this much more dovish direction. They would really have to be very, very convincing on the soft side of expectations for the markets to go, yes, well, there is a 2+ rate cut difference between where we are and where the Fed is, but these numbers will surely shift them in that direction. So the markets are already so dovish that it would really take a very dramatic reading on the soft side to get them to move in some sort of a different direction on the positive sentiment side, to find follow through, at least from this as a vector. Now, of course, as we've just learned from Nvidia, the markets don't necessarily need for sentiment to follow this or that lead. As long as things are tolerable, the lead can be negative and the markets can shrug it off all the same. But if there were to be a policy lead from these numbers that supports sentiment, it would have to be a significant deviation for how dovish the markets already set themselves up relative to what the Fed has actually confirmed, or at least projected. So what's the likelihood that we get that kind of outcome? Well, we can see that actually the trend has been the other way. So we've seen that the 6-month annualized PCE reading has been increasing, and now the higher frequency 3-month annualized reading has been creeping up. In June, we saw an uptick. In July, it looks like we'll probably see an uptick again. Moreover, the sort of benchmark forecast from the Fed's own modeling, this is the Cleveland Fed's inflation modeling that the markets look very closely to, we can see that realized results in the blue and the red here have increasingly deviated on the upside versus the model. There was a little bit of a convergence in April, but since then the disparity has only increased. And so while it seems baseline that the markets are pricing in higher inflation, that much seems clear, the degree to which realized data has come into the same direction has been much more emphatic. We can see inflation is running hotter than even these projections have it. Moreover, we can see from the ISM services index, services, of course, the largest part of the US economy by far, that we've seen a steep rise in the price component, and both PCE and CPI lagged 2 months behind this component, would probably be expected to go up here were this to hold. This is the big surge in what seems to be massively accelerating reflation, and we're just in the window for it here. So, with this in mind, the question becomes, what are we going to learn from these numbers that is going to give the markets something adjacent to this kind of a response? Risk on because easing. And the bar again seems very high, much as it did for a positive sentiment boost from Nvidia. That did not change that we still got a positive sentiment response, not because of Nvidia, admittedly, but in spite of it. Perhaps because the markets went back to where they were here and said, well, sure, the AI narrative may be getting soggy, but nevertheless, these rate cuts are coming. Let's reset for that world here. And so the key question for us is going to be, are we going to get anything from these numbers that we don't already know, having fully, or at least certainly for the most part, discounted a September cut? So these numbers wouldn't tell us anything different on that front unless they wildly deviated. And are they really going to change anything in this disparity in a sentiment positive way for markets that want rate cuts? Probably not. And so the question then becomes, are traders prepared to just close their eyes and keep the rally going? Or will we finally get to a place where this market will have run out of sentiment positive catalysts, or at least sentiment positive, sentiment devoid of catalysts, or refusing of accepting them? And that we're going to have to find out as the week closes out. This is macro money for this week. We are, as ever, here Monday through Thursday, right after overtime, show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. We return on Monday next week. Back to regular scheduled programming, Mondays and Fridays on Futures Power Hour with Chris. First call next week is going to be on Monday with Chris and Tom, a day later rather than Sunday, because, of course, the Labor Day holiday is going to keep things offline. Still writing for the news and insights portion of tastylive.com as ever, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you want. Good luck out there. Macro Money's back next week.